With an unprecedented $289 billion in total backlog, RTX Corporation is reporting phenomenal growth, yet the broader market remains strangely skeptical today. But does this mean Wall Street is entirely wrong, or is there a hidden fundamental trap that retail and institutional investors are simply choosing to ignore? Looking at the second quarter, organic sales surged 16% to reach a staggering $24.7 billion in revenue. At first glance, headlines scream about a standard earnings beat for the defense giant, but unpacking that $24.7 billion reveals the firm is capturing surging demand across both commercial aviation and military modernization. They are not just selling more hardware like engine spare parts. Management is pushing price increases through their pipeline to offset economic pressures and rising component costs. This brings us to the real foundation of the company, their total backlog jumping 22% year over year to reach $289 billion. Most analysts are focused on quarter-to-quarter fluctuations, completely missing the sheer scale of this multi-year revenue moat. That $289 billion in total backlog represents highly predictable future income, built on heavy physical hardware like advanced jet engines. For the business, this massive pipeline shifts the primary investor question to exactly how fast they can manufacture these physical assets. But delivering complex hardware is completely useless if it does not generate profit, making gross margin expansion to 20.8% incredibly significant. The consensus view assumes supply chain disruptions and an inflation rate currently sitting at 3.5% would inevitably crush industrial profitability. Instead, RTX Corporation saw its operating margin expand to 11.4% this quarter. This demonstrates the firm possesses formidable pricing power and rigorous cost control. Expanding margins alongside double-digit revenue growth is the exact financial formula that triggers upward valuation re-ratings from major institutions. To fully grasp why this profitability is resilient, we must look at the underlying liquidity of the business. Operating cash flow surged by an astonishing 674% to hit $3.5 billion in the quarter. The crowd is captivated by adjusted earnings, but operating cash flow is the undeniable truth teller of financial health, leaving a robust $2.9 billion in free cash flow. This metric destroys bearish arguments regarding earnings quality. It proves reported profits are rapidly translating into cash, giving the company an ultimate cushion against market volatility. This cash generation perfectly explains why management confidently raised their forward outlook. They officially increased full-year adjusted earnings per share guidance to a range of $7.10 to $7.25. While average observers assume executives always temper expectations, this upward revision acts as a powerful catalyst for confident institutional buying. Furthermore, raising free cash flow guidance to a high end of $8.75 billion suggests the firm has incredibly clear visibility into its production timeline. And yet, beneath this optimistic guidance, there is a fascinating tension brewing within their operational segments. The Pratt and Whitney division saw segment revenue jump 16%, largely driven by lucrative aftermarket servicing. However, commercial original equipment sales actually dropped by 8% due to complex engine mix pressures. The business is navigating a specific manufacturing hurdle regarding rare powder metal parts, requiring costly fleet inspections across commercial airlines. Investors must carefully balance booming aftermarket repair revenues against the heavy capital costs of manufacturing remediation. This operational tension heavily influences how the company handles its overall capital allocation. During the quarter, RTX Corporation deployed $983 million in cash dividends directly to its investors. Based on reported net income, this translates to a healthy dividend payout ratio of exactly 46%. Interestingly, the firm executed exactly $0 in stock share buybacks during this period. Instead of inflating earnings per share through aggressive repurchases, management chose a highly conservative strategy to optimize the balance sheet and protect their long-term structural liquidity. That conservative financial approach brings us to the overall solvency and structural leverage of the business. The debt-to-equity ratio improved to a highly manageable 0.56, reflecting a deliberate de-risking phase by corporate leadership. In a macroeconomic environment where the target range for the federal funds rate remains elevated at 3.50% to 3.75%, holding excessive variable debt is toxic. By systematically reducing total leverage supported by an expanding war chest of $8.3 billion in cash and cash equivalents, the company is insulating itself to self-fund factory capacity expansions. Beyond managing debt, the business is actively optimizing its operational footprint to maximize shareholder returns. Selling the Blue Canyon Technologies division for $620 million is a masterclass in corporate portfolio optimization. By shedding non-core peripheral assets, management is rapidly freeing up capital to aggressively reinvest in highest-margin aerospace and integrated defense systems. We see the immediate benefit of this renewed focus as the firm was awarded a massive $1.3 billion contract strictly for advanced engine spare parts. Streamlining operations and cutting out distractions instantly improves the return on invested capital for the core franchise. Before declaring an absolute victory for shareholders, we must acknowledge a quiet, lingering drag on the bottom line. The company officially recognized a $69 million pre-tax litigation charge in the second quarter, highlighting ongoing regulatory and historical compliance friction. While headline financial prints are stellar, these legal burdens represent an anchor that institutional algorithms constantly monitor. If these legal friction points escalate over time, they could slowly erode the operational efficiency and margin expansion the business has worked so hard to build. Which brings us back to our opening question. Is the market unfairly skeptical? Or is there a trap lurking within that massive $289 billion total backlog? The ultimate verdict is that RTX Corporation has successfully parlayed robust global aerospace demand into a highly lucrative multi-year earnings expansion that simply cannot be ignored today. The company is overcoming internal manufacturing hurdles through sheer industrial scale, immense pricing power, and highly disciplined capital allocation. For the intelligent investor, the current valuation does not appear to be a fragile value trap, but rather a reflection of an absolute compounding machine. Supported by pristine liquidity and rapidly accelerating free cash flow, the firm offers a highly compelling margin of safety against macroeconomic turbulence. While regulatory hurdles and specific engine manufacturing defects require careful ongoing monitoring, the fundamental reality is overwhelmingly positive. This resilient business is structurally positioned, capitalized, and managed to thrive in a modern era defined by elevated global aerospace needs. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.